The market is expensive, is what we are all hearing.
The Dow actually hit an all-time high yesterday.
This is exactly what you want to see.
This is signs of a healthy market.
Percentage terms.
But here's the real question. Is it actually expensive? And expensive compared to what? Our past or the rest of the world? So let's cut the noise. Our team has pulled out the hard actual numbers. 26 years of market valuations, MSCI country data, RBI growth projections, and I've put everything right here on the board. And in the next few minutes, we're going to answer the only question that matters to you as an investor. Are the Indian markets really overvalued or just misunderstood? Stay with me while I unpack this for you. Let's start simple. What does expensive mean? Where do I as an investor look to understand this? Most people look at PE, that's price to earnings. How much you're paying for every rupee of profit. If Nifty's PE is 22, it means the investors are paying 22 rupees for every 1 rupee of earnings. To know whether that's high or low, we need reference points. Over the last 26 years, the Nifty 50's PE averaged around 18 to 21 times. Today, it's around 22 to 23 times, slightly higher than normal. But here's the catch. This comparison isn't apples to apples. Earlier, Nifty PE was calculated using standalone earnings. From March 2021, NSE switched to consolidated earnings. Consolidated earnings are naturally higher because they include profits from subsidiaries. So if today's PE is 22 to 23 times, it would have looked higher under the old method. Meaning, the premium today is bigger than what the chart shows because the calculation changed. Now let's look outward. But again, where do I as an investor look to understand this? MSCI or Morgan Stanley Capital International builds global indices around the world. Their benchmarks are used to measure nearly $18 trillion of assets worldwide. So on this common scale, India trades at 25.6 times versus the emerging market basket at 16.4 times. That's a 55 to 60% premium over emerging markets. And compared to peers, well, all of them sit lower. China at 15.8x, Taiwan at 20.84, Korea at 13.73, Indonesia at 14.18, and Brazil at 9.27, while India is at 25.6, clearly at the higher end. So yes, on a global basis, India does look expensive. But wait, it gets even more interesting. To get one level deeper into the global comparison, we compared global giants with their Indian counterparts, which means same brand, same products, same technology, but the price we are paying, let's see. Nestlé India trades at a PE of 82.2, while its parent Nestlé SA in Switzerland at just 22.2. Hindustan Unilever commands 56.5 versus Unilever PLC in the UK at 30x. Siemens India 64.3 compared to Siemens AG in Germany 21.4. Pfizer India 36, while Pfizer Inc. in the US is barely 12.8. Investors in India are paying 2 to 3 times the valuation multiple of the Indian business of the global parent. These are massive gaps. The obvious question is, why is India paying such a huge premium? We'll come to that, but first there's one more important piece. According to RBI's latest financial stability report, to justify today's valuations, Nifty 50 needs 14.4% earnings growth, while the expected growth is only 10.4%. For mid-caps, market expects 28% growth and forecasts say 17.4%. For small caps, market expects 30.6% growth, forecasts say 16.9%. This again is a big gap. It means share prices have already jumped ahead of actual profit growth. And investors are paying now for profits that may only come after 2 to 3 years. If companies don't earn as much as expected, prices could stop rising or even fall. So with all this, the obvious question becomes, if valuations are high, if expectations are stretched, if RBI itself says growth has to catch up, why are people still buying? Because investors are betting on the future, not the present. And India's future right now looks strong. Here's what the numbers say. India's ROE is rising sharply. ROE means how much profit companies generate from their own capital. Indian companies' average ROE has improved post-COVID, stabilizing around 15 to 16%. Now look at other countries. Brazil, the UK, Korea and the Philippines deliver ROE of 10 to 13%, but their earning yields are higher, around 7 to 10%. Meaning they are cheaper, but investors also feel these markets carry more macro risk. Then there's the US, the profitability king. ROE is 18 to 19% but offers the lowest earnings yield, 3.7%. The US market is expensive because investors pay for capital light, high quality, super profitable businesses. And here's where India comes in. India's ROE is slightly below the US, but earnings yield is also low at 4.1%. This tells you something important. Investors aren't paying for today's profit. They are paying for durability, growth visibility, and how the next 5 to 10 years could look like. And that's why a higher PE doesn't automatically mean bubble. As Professor Ashwath Damodaran says, a high price isn't bad by itself. It's only bad if future growth doesn't justify it. Another reason the market stays elevated is domestic money is more powerful than FII money. SIP accounts have grown to 9.72 crores. Same with SIP contributions. They have surged consistently over the past 5 years, rising from around 10,000 crores in September 21 to 29,000 crores in September 25. Let's look at ownership too. FII's share in NSE listed companies fell to 17.3%, the lowest in 13 years. Meanwhile, domestic mutual funds are at a record 10.6%, and overall DIIs have been above FIIs for 2 straight quarters, something last seen in 2003. Local investors simply refuse to leave the market. But before we move on to conclude, here's a crucial thing to note. A single market PE can mislead you because different sectors work differently. So the market looks expensive partly because the industries with the highest weight today are also the ones with the highest PEs. This mix wasn't the same 10 or 15 years ago. This is why simply looking at the headline PE doesn't tell you the full story. Everything now depends on earnings. There are 2 scenarios that can play out. Scenario 1. If earnings accelerate, India's GDP projections are 6 to 6.5% among the highest globally. Formalization is rising, manufacturing is picking up. GST collections are at 1.89 lakh crore. Urbanization, digital infra, capex cycle all strong. Goldman Sachs says India could sustain 6 to 6.5% growth till 2030. If earnings catch up to these valuations, the current premium holds. Scenario 2. If earnings disappoint, then valuations will reset. Not collapse, but cool off. Prices may wait for earnings to catch up. But here's the bigger picture. India may still command a permanent premium because demographics, stable macro, rising domestic flows, lower dependence on exports, and strong consumption. So, is the market overvalued? It's not a simple yes or no. The better question you can focus on is which parts of the market are worth their valuation and which are not. What do you think? Do tell us in the comments. And if you found this video insightful, do like the video and subscribe to the channel.
Ready?
I have been ready.
Rolling and action.
Over the last 26 years, दिन बहुत fast है भाई. MSCI और Morgan Stanley. अच्छा ये दूसरा पार्ट है, सॉरी. इसको ऊपर था ना, नीचे कर. Wait. ऐसे ही होता है जब सुबह से रात तक बैठाते हैं. हाँ बस. 1 सेकंड खत्म हो गया.
What?
You haven't subscribed yet. Please subscribe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.